We're going to chapter 32, economics, monetary policy. When we talk about monetary policy, basically we're talking about a government policy that involves using money supply and interest rates to control aggregate demand, because whatever we do is based on what we buy in the economy, our consumption. So if government has to come up with, government wants to control what we consume. So if there's a way to control what we consume, government can, we call them instruments, an instrument, a policy instruments that can be used to control what we consume. One of them is monetary policy. So let's go down and see what they wrote here. Monetary policy. Okay, they said in chapter 31, chapter 31 looked at how a government could influence aggregate demand by adjusting level of taxation and government expenditure. That is using fiscal policy. Then another way of controlling aggregate demand in the economy is to adjust interest rate or the money supply. This approach of demand management is called monetary policy. Aggregate demand in the economy is affected by growth in the money supply. The money supply is the total amount of money that circulates in the economy. It is quite difficult to define the money supply. Economists use a number of methods. One simple way is to remember that the money supply includes all notes and coins in the economy plus any money held in bank accounts. So for money supply, it means the inflow of money cut across the country, cut across the economy, how money flows across the country. That is what money supply is. So when we talk about this money supply, so we're talking about the coins, the notes, and money that are kept in the bank. So all these things will find their way into the system. So how they find their way into the system is through monetary policy, which can be interest rate or money supply. So what is interest rate? Okay, let's just go down to interest rate now. For interest rate, they said interest is a price paid to lenders for borrowed money. It is the price of money. So for example, so for interest rates, interest itself is the amount you pay for borrowing or saving. So here, they said in most countries, there are many different rates of interest. There are a number of reasons for this. So what are the reasons why we have different rates of interest? First, you have to understand what interest rate is, the price of borrowing or saving, which can be used to correct or to control aggregate demand. So when you link interest rates to aggregate demand, it's basically talking about how much you can borrow or how less you can borrow. You understand? Because it's the price of borrowing. So the amount you can borrow will be determined by the level, the rate of interest. So if the rate of interest is high, you might not be willing to borrow more. But if the rate of interest is less, then you can borrow more. So when you can borrow more, it affects our aggregate demand. When you can borrow less also, it affects the aggregate demand. That is what we want to look out onto now. I think interest rate is clear. So they said different countries have their own different interest rates. And what are the reasons? One, different bank charges different rates as they compete with each other for business. So one of the reasons why we have different interest rates in countries is that different banks have their own rate of interest because they have to compete with each other. So competing with you meant that my price is less than yours. So if I have to get more customers, I have to sell at a price lower than yours. So that means and what are we selling? We are selling loans. We are selling loans, right? So we are selling credit. So if the price of borrowing from me is less, I would be willing to borrow from you. They will be willing to borrow from me. But if it's yours that is lesser, they will be willing to borrow from you. That's the first point there. I think it's clear. Two, rates are higher if money is borrowed without security. So another reason why there are differences in interest rate is that interest or borrow loans that are secured loans. That means they have collateral. So the amount you pay for loans that are secured is less than the amount you have to pay for unsecured loans. For unsecured loans, you have no collateral. So there's no asset attached to it. So the banks know they might be losing. So they will charge high rates to discourage you from borrowing. They don't want to tell you no because they wouldn't want to say no, but they might give you high interest rates to discourage you. And if you are willing to pay such, it's fine for them. So that's the second reason. If the secured loans are lesser than unsecured loans in terms of their rates, I think it's clear. We're talking about reasons why we have different rates of interest. The first one is that different banks charge different interest because they are into competition. The second one is that secured loans, there are secured loans, there are unsecured loans. Secured loans have lesser interest than unsecured loans. I think the second is clear.
I want to ask,
yes.
Collateral.
Collateral assets that are linked, that are used to stand for for the money you are borrowing. So if I'm going to borrow 500,000 from you, I would have assets worth of maybe 1.5 million. So that asset that I'm using is a collateral. So it's standing for what I'm borrowing. In case I did not pay back, you will be able to sell my asset and get your money and return the remaining change for you. Clear? The third reason, the amount paid to borrowers is higher than the amount given to savers. This allows money lenders such as banks to make profit. So another reason why we have different rate of interest is, we said the rate of interest is the price of borrowing and the price of saving. So if you are saving, the interest you get, the amount paid to borrowers is higher than the amount given to savers. So if you are saving, you get less. But the amount banks will get from borrowing you is higher than the amount you get from saving. You get the point here? The amount they give to those that are borrowing from them in terms of interest is higher than the amount they pay to savers. Do you understand? So that's another point. And the last one, some of the highest rates of interest are charged to credit card users. So for example, they said, in contrast, the rate, for credit card users, because you are going to, you have your card is already loaded with that amount of money that you don't have. So because you don't have that amount of money, if you are going to pay back, you have to pay more because the bank is giving you what you don't have, and you're going to spend what you don't even have in your account. So for that to happen, for banks to be willing to do that, they have to charge you high. Do you understand? So these are the reasons why we have different interest rates. Clear? Good. So we'll go on. Now go to the role of central banks in setting interest rates. So in many countries, do you know what the central bank is? The central bank is the apex. The apex, we call them the apex banks. Apex, that means the highest in authority. So the central bank is in charge of monetary policy in most countries. Clear? So let's say in many countries, interest rates are set by the central bank. Central banks play an important role in the economy so what are the roles of central bank? Number one, implementing the government's monetary policy and regulating the banking system. So it is the role of the central bank. So whenever, there's the Ministry of Finance, there's the Ministry of Commerce. These are government executives. These are they take charge of the economy. They take charge of the country. So what they do is they come up with different policies, inviting the central bank governor and executives to look at it in the monetary aspect. So as soon as they all agree on it, then they implement it. And how do they implement it? They implement it through these commercial banks, because individuals, businesses will deal with commercial banks, not the central bank. But the link between the central bank and the people is the commercial bank. Do you get it? So whatever government of the country wants to do, which involves monetary policy, they use the central bank, and the central bank uses the commercial banks to reach the people or the firms. So they're going to implement government policies. They're going to implement government monetary policy through regulating commercial banks, checking on the activities of commercial banks. So if government wants to reduce money supply in the economy, the central bank is not distributing money. It's not the central bank that distributes money. It's the commercial bank, because that is where you save your money. You don't save in the central bank. So the central bank would reduce the amount given to commercial banks, but the central bank will come up with policy that would make commercial banks to reduce the amount of money they are supplying to the economy. Do you understand? So whatever the government wants to do, they use the central bank. The central bank will come up with different regulations that the commercial banks has to follow. That is the first point. I think it's clear. Another role of the central bank is that they act as lender of last resort to commercial banks. When we talk about lenders of last resort, we're talking about the people, the institution that commercial banks will go to when they are when they have cash problems, when there's no more cash, when they have nowhere to go anymore. So they fall back to the central bank. So it's the central bank that rescue them whenever there are issues with the commercial bank. That's why we call them lender of last resort. Clear? They are the ones the commercial bank goes to whenever they have issues. Clear? The third one, controlling inflation and stabilizing the nation's currency. So it is the central bank of the country that decide on the exchange rate.
Yeah.
You get it? Yeah. They said controlling inflation and stabilizing a nation's currency. I'm going to talk about the nation's currency first before talking about inflation. For the nation's currency, we're talking about the exchange rate. So it's the commercial bank that comes up with the rates. So right as of now, using Libya as a case study, the rate of exchange is 7 point something now. So the Libyan dinar has been devalued through the central bank. So it is the central bank that does it. So for inflation, sometimes we have demand pull inflation. If it is based on demand pull inflation, demand pull inflation is as a result of increasing aggregate demand. So the commercial bank, the central bank might increase the interest rates. Do you know what I'm saying? The central bank might increase the interest rate so that borrowing becomes higher. So if borrowing becomes higher, then nobody wants to borrow. Do you get the point here, please?
Yes.
So that's how they use interest rate and nation's currency to decide. So for inflation is linked to interest rates. For nation's currency, it is linked to exchange rate. So if there's inflation based on the demand pull inflation, the central bank will increase the interest rate so that the price of borrowing becomes higher. And when the price of borrowing is increasing, it becomes a disincentive. It demotivates people to borrow. Firms will not want to borrow. Households will not want to borrow because the price is high for them.
Yeah.
So they don't want to borrow. As a result of that, demand pull inflation would reduce. A high interest rate would encourage people to save more. Do you see? So saving more means spending less. Spending less would stop increasing aggregate demand. That is for inflation. And for stabilizing the nation's currency, we're talking about the exchange rate, which is the price of a country's currency in relation to other countries' currencies. So it's the duty of the central bank of Libya to devalue or to revalue the currency. So right now, the Libyan dinar is devalued because it's 7 points to the dollars. So that is devaluation. I think inflation and stabilizing the nation's currency is clear. And the last one is setting interest rate. Still going back to the third one, which is controlling inflation. Controlling inflation is demand pull inflation, which I said the central bank can do that using the interest rate. But now let's talk about the interest rate itself. It is the duty of the central bank to set the interest rate. And if it is being set, all the commercial banks must go in line with it because the central bank watches or monitors the activities of the commercial banks. Is it clear? So go down. Impact of interest rates, changes on macroeconomic objectives. Are you there? Changes in the level of interest rates can have an impact on a number of economic variables and help to achieve a government's macroeconomic objective. One. So what are the impacts of changes in interest rates in terms of macroeconomic objectives? Now, you know what we talk about macroeconomic objectives? We're talking about government economical objective, which is to increase employment opportunity or to reduce unemployment, to reduce or to stabilize the prices within the economy, which is low inflation rates, to increase the economy by making sure that the economy is growing, to reduce the balance of to make the balance of trade or the balance of payment to equal. So these are economic objectives. So how does these things influence? It is being influenced by interest rates. That is the point they're making there. Do you get my point here? Macroeconomic objectives are government objectives set to what government is aiming to achieve within an economy. One is to reduce inflation as much as possible, to increase employment opportunity or to reduce unemployment, to ensure that the country's export is more than import, and to ensure that there's economic growth. These are macroeconomic objectives. So government can reach these objectives. Government can be able to achieve these objectives using interest rates. So how can interest rates be influenced or can be used to achieve government's macroeconomic objectives? That is where we are going. Are you getting the point? Yeah. So the first one, inflation. Monetarists believe that inflation is caused by the money supply growing too quickly. They say that the way to reduce inflation is to slow down the speed at which the money supply is growing. This is likely to involve raising the rate of interest. When interest rates are higher, borrowing is likely to fall, and the money supply grows less quickly. This will help to reduce aggregate demand in the economy and limit price increases. So, inflation is a persistent rise in the prices of goods and services, right? So, if there's persistent rise in the price of goods and services, it is as a result of increasing demand within the economy. So because we continue to demand more, firms will seize the opportunity to raise the price. Raising the price brings about inflation. Yes or no? Yeah. Why are we demanding more? Because our level of, we're having much with us. That's why we demand more, right? Now, government will use interest rate, increasing the rate of interest. By increasing the rate of interest, even if you don't have to, you have the income with you. Based on the fact that you understand that the interest rate is increasing, why do I have to spend? Why can't I save? That is the question that comes to your mind. Why do I have to spend? Instead of seizing the opportunity to make more with this high interest rate, then let's start saving. So people stop buying. So money supply would reduce because there's no more supply in the economy. Money is not going in and out anymore. Money is just going into the bank, into the banking system. So people are not spending. As a result of that, supply of money would fall, aggregate demand would fall, inflation would reduce. Is inflation clear? So, unemployment. Do you have a question or I should further?
No.
Unemployment. A government might use lower interest rates to reduce unemployment. If interest rates were cut, there will be an increase in demand for loans. As a result, spending by firms and households would increase. This would increase aggregate demand and firms would respond by producing more goods and services. This means they would need to recruit more staff and therefore unemployment would fall. Interest rates linked to unemployment. Unemployment is a situation whereby people that are willing and able to work couldn't get one. That is unemployment. And one of government's macroeconomic objectives is to reduce unemployment or to increase employment, right? So government can use interest rates to do this. How can government use interest rates? Government will cut interest rates. Cutting the rate of interest means the price of borrowing becomes less. As a result of that, households will be able to borrow more. Firms will be able to borrow more for investment and capital growth. Now let's go back to the household. Having accessibility to loans means that I can have access to more loans. I can have more money with me. So because I can have more money with me, I'll be able to buy more. Yes or no? You'll be able to buy more. Yes or no? We will be able to buy more. So being able to buy more means demand within the economy will decrease. For firms, they have to respond by increasing their output. How are they going to be able to increase their output? They'll be able to increase their output by employing more workers to meet up with the demand of that we are asking for more. They have to employ more workers. Yes or no? As a result of that, employment increases within the economy. Unemployment starts falling. Is it clear? The third one, economic growth. Monetary policy might be used to help smooth out the small variation in the economic cycle. For example, monetary policy might be used to help get an economy out of recession. In the last 10 years, interest rates in many countries around the world have been very low indeed. There's a table, we don't need that. The reason for this is to stimulate more economic growth. So, economic growth means increasing output. So, if we are to increase our output, this is linked to firms, businesses. To increase the output, they have to be able to produce more. Yes or no? Being able to produce more means the ability to invest in capital goods. So being able to invest in capital goods will mean that they have access to money. How are they going to be able to have access to money? That is when it is easy for them to borrow. So being able to borrow at a low interest rate will make that they can borrow to increase their investment in capital goods. Investment in capital goods will increase output, then the economy will grow. Clear? The current balance. A government could use monetary policy to adjust the balance on the current account. For example, to reduce the deficit, the government might decide to tighten the monetary policy. We call this.
It's like pressure.
We call it's like what?
It's like pressure.
Yeah, we call it it's like we have expansionary monetary policy and expansionary monetary policy, and what's the second one? Those of mine, expansionary, I forgot the term. Let me tell you, maybe I'm still going to remember. But yeah, if the government is tightening the economy, it means government is making sure that we don't spend more, especially on imports. Do you understand? So we don't spend more. We call it expansionary fiscal policy or discretionary. I forgot the word. I forgot the term. If I remember, I'll say it anyway. So what government will do is government wants to make sure that they use monetary policy to reduce importation, because it is when importation is increasing in the economy, that's when we have deficit in our balance of payment. So to reduce deficit in our balance of payment, or to reduce or to improve our balance of payment, we should either do less of imports or do more of exports. So this is what they are talking about here. So if they said, however, if interest rates are raised, the exchange rate might also increase. This would make export more expensive, import cheaper, and worsen the current balance. No, before I go there, they said, for example, to reduce a deficit, the government might tighten the monetary policy, yes. This would lower aggregate demand and reduce spending on imports. However, if interest rates are raised, the exchange rate might also increase. Then there's a problem here. When you increase interest rates, when you increase the interest rates of the country, it means savings increases, yes or no? This will definitely appreciate the country's currency. Why? Foreigners will come to need more of the dinars so that they can save more of the dinars. As a result of that, the value of the dinars increases. You have to understand how this thing works. I'm going to explain again. Increasing the interest rates might increase the exchange rates. How is interest rate linked to exchange rates? That is the point. Interest rates is the price of borrowing and saving, right? Exchange rate is the price or is the value of the country currency in respect to other countries' currencies, right? Now, an increase in interest rate might bring about an increase in the exchange rate. How is it possible? They are not the same thing, right? But an increase in one might increase the other. That is the point I'm making here. So how does it happen? If the interest rate increases, if the interest rate in Libya increases, that means savers, they will have to save dinars into the bank to enjoy the interest rate, yes or no? Foreigners that are savers too, they will come into the country needing more of dinars to be able to save in Libyan banks. So that means the demand for dinars would increase. And remember we said the rate of interest when we're talking about exchange rates in some previous topics, we said the exchange rate is determined by the rate of interest, the demand for and the supply of the money. Yes or no? So if dinars, now that the interest rate is increasing, people will need more of dinars so that they can save into the bank. Foreigners will come, they will need more of dinars. So the demand for dinars would rise. And as soon as the demand for dinars rises, dinars will increase its value. So that is what they are talking about here. So as soon as that happens, the price of exports increases, import reduces. This will cause a deficit in the balance of payment again, current account. Do you get it or not? Government wants to use an increase in interest rates to correct importation, to reduce importation, right? But when government does this, it might also lead to increasing prices of exports to bring about a fall in prices of imports. So this will bring about, this is what we call government failure. When government decision leads to another negative externality. Instead of welfare gain, it is welfare loss. That is what we're talking about here. So, however, they said, if interest rates are raised, the exchange rate might also increase. This would make export more expensive, imports cheaper, and worsen the current balance. I think the point is clear now. Good. So the overall effect on the current balance of higher interest rate depends on the following. So we wouldn't just say it's as soon as the interest rate is increasing, exchange rate will increase. So there are also other factors that will bring about balance of payments, current account, deficit, or surplus. One, the income elasticity of imports. So if demand for imports were income elastic, higher interest rate would reduce demand for them. This would improve the current account balance. So what they're saying is this: there's income, the amount of money we earn. Now, if demand for import, now we said the price of import is cheap, based on the fact that our exchange rate is high. So the first thing we need to think about is import rates. It's income. So whatever we are importing, if it is income elastic, that means the more income we have will determine the more import we could buy. So if it is income elastic, so higher interest rate would reduce demand for them. Get the point? If demand for imports were income elastic, that means if we have more income, that is when we can buy more of these imports. But if it is, as a result of that, high interest rate would reduce income, yes or no? So that means demand for import will still fall. That's why the fact that the price of import is less. Do you get it or not? There's imports, which is buying from foreign businesses. There's income. So if import is income elastic, it means we will be able to buy more as soon as our level of income increases. Now, with high interest rates, our income level would fall because we don't have more to spend, we have more to save. You know, we have disposable income. Disposable income is the amount we can spend or save. Based on the fact that the interest rate is increasing, we save more, we spend less. And what we want to spend on is on import that is cheap. But for the fact that we don't have more income with us, we won't be able to buy, despite the fact that the import is cheap. So high interest rate would reduce high importation here, the first point. The second one, the strength of the link between interest rate and exchange rates. If the link is strong, higher interest rate will raise exchange rates. Export will become expensive and import will become cheaper. The current account will be worse. If the link between interest rates and exchange rate is high, is so strong, it will definitely affect the balance of payments. Because if it is strong, it means as soon as interest rate is high, the exchange rate will high. Then exports becomes expensive, imports become so cheap. So the balance of payment will worse. Get it? The third point, the price elasticity of demand for imports and exports. If they are both price elastic and the exchange rate does rise when interest rates rise, import will be cheaper and export will be dearer. This would worsen the current balance. So if the price elasticity of demand for import and export, so if the price elasticity, that means they said the price elasticity of demand for import and export. So if they are both price elastic, that means if they are both price elastic, it means a high in price would reduce the price, will reduce the quantity demanded. A high in price would not increase the quantity supplied. Get the point here? An increase in price would reduce the quantity demanded. An increase in price would not increase the quantity supplied. That is what they're talking about here. So if an increase in price will reduce the quantity demanded, imports will be cheaper, export will be easier. Do you get it? And if an increase in price is unable to increase the quantity supplied, it will still be the same thing. The current account will be worse because we cannot produce more, despite the fact that we can't produce more. But though import is cheaper, but we can't buy raw materials to produce more. There's price elasticity of supply. The degree of responsiveness between the quantity supplied and as a result of a change in price. Now, the supply for this product is price elastic. The price is increasing, but we are unable to supply more based on the fact that we are unable to get more in, or people are not buying our exports because the price is high. Do you get it? We can import raw materials, but we can't sell because the prices of our export is high. So this will still worsen our balance of payments, current account. Is it clear? So these are the reasons why, these are the ways in which the interest rate might affect all macroeconomic objectives. And for the last one, which is about the current account balance, an increase in interest rates would increase the exchange rate, definitely. But there are factors that would make that there are factors that we have to put into consideration if we have to check the nature of the current account, if it's going to be deficit or surplus. If the interest rate is high and the link between the interest rate and the exchange rate are strong, then it will make the balance of payment current account to worse deficit. If the interest rate is not strong, it makes the balance of payments to improve. That's the first point. The second one is about income elasticity and importation. If the price of imports, if income is linked, if the price of import is linked to income, if it's income elastic, then it means no matter what happens to the import prices, we won't still be able to buy. The third one is about elasticity of import and export based on demand and supply. If the prices are increasing, if the price of export are increasing, imports will be cheaper. We'll be able to produce more, but we won't be able to sell. That's the point. And for demand, if the prices of imports are increasing, but for the fact that we have to save more, we won't still be able to buy imports. That is the point there. I think it's clear. All right, so we'll go down to the mechanism by which interest rate changes affect consumers and firms. So changes in the interest rate can have an impact on aggregate demand. The impact occurs because of the way consumers and firms respond to changes in the interest rate. One, for consumers, how do they respond to changes in interest rate? I read. When interest rate falls, demand for loans from households will rise. Consumers are likely to borrow money to buy goods such as cars, furniture, holidays, because borrowing is cheaper. Also, when interest rates fall, consumers with a mortgage may find that their mortgage payments fall. This means they have more money to spend, which will also increase aggregate demand. Finally, if the interest rates are lower, the work to savers is also lower as a result. This might encourage people to spend rather than save. In contrast, with interest rates, when interest rates rise, consumers try to reduce borrowing because it becomes expensive. As a result, demand for goods using borrowed money will fall. Also, mortgage payments will demand for goods. Also, mortgage payments will rise automatically. Therefore, households will have less disposable income to spend and will have to cut some of their expenditure and reduce their savings. So for consumers, they have two responses. If the interest rate is low, they can borrow more. As a result of that, their spending increases. Aggregate demand will increase. Even for mortgages, their loans payments would fall. So they have more disposable income to themselves. But if the interest rate, in contrast, if the interest rate increases, mortgages rises automatically, the price of borrowing would increase. Savings, the price of savings will rise. Then there will be more incentive to save than to spend. Aggregate demand would fall. Clear for consumers. Then for firms using borrowed money such as mortgages, loans, and overdrafts to fund their business activity are likely to respond to changes in the interest rate. For example, when interest rates fall, the interest payment on current borrowings will also fall. This will help to boost their profit because costs will be lower. Lower interest rates are also likely to raise levels of business confidence and stimulate more investment. Since a large proportion of business investment is funded through borrowing, lower interest rates mean that the returns on investment are likely to be higher. Therefore, more investment is likely to be undertaken. In contrast, higher interest rates will raise costs, lower profit, reduce business confidence, and make entrepreneurs more conscious. As a result, investment in the economy is likely to fall. So it is the same response for firms. As soon as the interest rate increases, firms would not want to borrow more because the price of borrowing has increased. Their profit would reduce because they have to pay interest from their profit, which reduces their profits. As a result of that, they become cautious. They don't want to spend more. They don't want to borrow more to invest in capital goods. Investment would fall. On the other hand, if interest rate falls, they have the incentive to borrow more because the cost of production would fall due to borrowing, the cost of borrowing reducing. So that means the return on investment would increase for them. They have more incentive to borrow more. Investment in capital goods will increase. They will increase more. They can expand. They can increase their output. I think it's clear. There's also a link between the interest rate and the exchange rate. When the interest rate falls, the exchange rate is likely to also fall. When the interest rate increases, the exchange rate is likely to increase. So when the interest rate falls, businesses that do exports would have increase in the demand for their exports, because the price of exporting becomes cheaper. Foreign customers will find it interesting for them to buy more from us because the value of our currency has fallen. As a result of that, export would rise, making it profitable for firms to do more exports. But the price of imports would rise. So firms that do more of imports, especially that import raw materials, will find it difficult to produce at a reduced price. So export businesses will thrive, will do better. Import businesses would fail. Do you get it? And the current account will improve if export is high. The current account will decline if import is increasing. Clear? We go on to the use of asset purchasing by central banks. In recent years, many countries have tried to control the money supply using a method called quantitative easing. When we talk about quantitative easing, this means we use what we have to buy assets from the bank, like bonds, like what else do we buy? We buy bonds, anything we can buy anything, like we buy bonds, and there's one call again that we can buy. We buy bonds. What else can we buy from the banks? I forgot some bank terms. When I remember again, I will say. So this involves central bank buying financial assets such as government bonds from commercial banks. This results in the flow of money from the central bank to commercial banks. This extra cash can be used by commercial banks as a basis for making new loans to consumers and businesses. When more loans are granted, aggregate demand will increase. So there's always, we said the central bank is the regulator. They are the banks to commercial banks. One of their role is bankers to commercial banks. So that means the commercial bank can buy assets that can be turned to cash from central banks. And when they buy this, it gives them more money. It gives them more money to their own vault. As a result of that, they have more money with them. They have access to more money, which they can give out as loan to people, which will increase their own profitability too. That is the point they are making here. Do you get it?
Can you repeat the last?
Quantitative easing means the flow of money from central bank to commercial bank. The commercial bank needs more money so that they can use it with people. People need more money for businesses. But if commercial banks do not have, how are they going to be able to give to people who want to borrow? So commercial banks use what we call asset purchasing. So that means they buy assets like bonds from central bank. So when they buy this, it improves monetary flow from the central bank to commercial banks. As a result of that, commercial banks have more access to money. So having access to money means they will be able to use money. They will be able to give money out. They will be able to use money for businesses. That means they can give it out on loan. And the interest paid on loan becomes their own profit. That is the point they are making there. Do you get it? Because when they give more loans, when they have more money with them, that means people can have access. Firms can have access. They can give more grants. They can grant more loans to people. Demand in the economy would increase. Those that have been borrowing will be able to come back with interest. That increases their own cash flow too. That is what quantitative easing is about. Having access to money through the central bank and being able to give money out to people who need the money so that aggregate demand can increase in the economy. This is what quantitative easing is about. Is it clear now? Good. Go down. Oh, multiple choice question. Which of the following, the first one, said, which of the following is most likely to rise if the money supply grows too quickly? Which of the following is most likely to rise if the money supply grows too quickly?
Say inflation, because when the money supply grows too quickly, the aggregate demand,
people have more access to money. Having access to money means being able to spend more. Aggregate demand will increase. And an increase in aggregate demand will bring about inflation. So the answer is A. Good. The second one. An increase in interest rates is likely to bring about which of the following? An increase in interest rate.
Savings.
It will increase savings because when interest rate is increasing, it means you have more incentive to save rather than to spend.
So higher interest rates will encourage people
to save.
Yeah.
So what are you saving? You are saving from your disposable income, which is the amount of money that is left with you to save or to borrow, to save or to spend. But if interest rate is increasing, you rather save than to spend. Clear? Here they said increase inflation. It cannot increase inflation because increase in interest rate would reduce spending. So inflation would rather fall. Reduce unemployment. It will not reduce unemployment. It will not reduce unemployment. It will rather increase unemployment because an increase in interest rate will mean spending would fall. And when spending falls, firms will not be making more revenue. As a result, they might have to let go of workers. They won't employ. The third one, increase the demand for imported cars. There's nothing like importation here because spending is more than saving. Saving is more than spending. It is what you have that you can spend on imports. Yes or no? Yes. So import will not increase, inflation will not increase, unemployment will not reduce. The answer is still clear. So that ends monetary policy, chapter 32. Whoa, it's a long topic, man.